How a war with Iran could disrupt global logistics and supply chains. Why a conflict in Iran matters to global logistics. Imagine this situation. A manufacturer in Europe suddenly receives a message from a freight forwarder. Ocean freight rates have doubled, vessel schedules are uncertain, and fuel surcharges are rising again. The cargo itself is not moving anywhere near Iran, yet the disruption is happening across global shipping networks. How can a conflict in the Middle East create delays and rising logistics costs for companies thousands of kilometers away? This is one of the most important realities of modern global logistics. Today's supply chains are deeply interconnected. A disruption in a single strategic region can ripple through shipping routes, fuel markets, air cargo networks, and manufacturing supply chains around the world. If content like this helps explain how global logistics really works, consider liking the video and subscribing to the channel. Iran sits in one of the most strategically important regions for global trade and energy transportation. Right next to Iran is the Strait of Hormuz, a narrow maritime corridor that connects the Persian Gulf to the global ocean shipping network. Every day, a massive share of the world's oil supply passes through this small stretch of water. Because modern logistics depends heavily on energy, any instability in this region does not remain a local issue. It quickly becomes a global logistics story. Shipping costs, transportation networks, cargo insurance, and delivery reliability can all change within a very short period of time. To understand why, it is important to start with the most critical location in this entire discussion. Strait of Hormuz, the most critical choke point in global shipping. The Strait of Hormuz is often described as one of the most important maritime choke points in the world. A choke point in logistics simply means a narrow route where a large amount of cargo must pass through. When that route becomes unstable, global trade can slow down very quickly. The Strait of Hormuz is only about 40 kilometers wide at its narrowest point, yet roughly one-fifth of the world's seaborne oil shipments move through it every single day. Oil tankers carrying energy from the Gulf region travel through this passage before heading toward Asia, Europe, and North America. If a military conflict involving Iran escalates, several types of disruption could appear in this area. Naval tensions could increase. Commercial ships might face security risks. Shipping companies could slow down traffic through the area. In extreme scenarios, shipping lanes might temporarily close or become too dangerous for commercial vessels. Even small disruptions can have large consequences. Oil tankers may need to delay departures. Shipping companies may reduce voyages into the Persian Gulf. Ports in the region could experience operational slowdowns. For global logistics networks, this creates immediate uncertainty. Energy shipments slow down, supply tightens, and transportation markets begin reacting almost immediately. But the biggest effect appears in one critical area that powers the entire logistics industry: oil prices and the cost of transportation. Fuel is the invisible backbone of global logistics. Every container ship crossing an ocean burns bunker fuel. Cargo aircraft consume large amounts of jet fuel. Trucks transporting containers between ports and inland warehouses rely on diesel. Even cranes, port equipment, and rail locomotives depend on energy to operate. Because of this, oil prices play a massive role in determining global logistics costs. When geopolitical tensions threaten oil supply routes, global energy markets react quickly. Traders anticipate potential shortages, and oil prices often rise even before actual disruptions occur. When oil prices rise, the impact spreads through every layer of logistics. Shipping lines pay more for bunker fuel, which is the heavy fuel used by container vessels. Airlines face higher jet fuel costs, which can dramatically increase the price of air freight. Trucking companies also face rising operating costs. These increases eventually appear as surcharges across the logistics industry. Ocean carriers may introduce bunker adjustment factors. Airlines may add fuel surcharges. Inland transportation providers may increase freight rates. For businesses and supply chains around the world, the final result is simple. Moving goods becomes more expensive. And when logistics costs rise, product prices often rise as well. However, fuel prices are only the first layer of disruption. The physical movement of containers and ships can also be affected. Container shipping disruptions. Global container shipping works like a large interconnected network of scheduled routes. Container vessels move between major hubs in Asia, Europe, the Middle East, in the Americas on carefully planned schedules. When geopolitical risk increases in a particular region, shipping companies may adjust those routes to reduce exposure to danger. If tensions escalate near the Persian Gulf, some container vessels may avoid certain regional ports. Shipping lines may reduce services in higher-risk areas. In some cases, vessels may take longer alternative routes. These adjustments can disrupt the delicate balance of global shipping schedules. When vessels arrive later than expected, ports can suddenly experience surges of cargo. Multiple ships might arrive within a short period of time, overwhelming port capacity. This leads to longer waiting times at anchorage, slower container handling, and congestion inside container terminals. Port congestion has been one of the biggest logistics problems in recent years. During the pandemic, congested ports caused severe delays across global trade routes. A similar pattern could appear again if shipping networks become unstable. Another major problem is container equipment imbalance. Containers move around the world in cycles. A container may carry electronics from Asia to Europe, then return with machinery or raw materials. When shipping schedules become disrupted, containers accumulate in certain regions, while other regions suddenly face shortages. Exporters may find it difficult to secure empty containers, while shipping lines struggle to reposition equipment across continents. This type of imbalance can disrupt manufacturing supply chains and export schedules for months. But operational disruptions are not the only challenge. Financial risk also increases during geopolitical conflict. Rising cargo insurance and security risks. Whenever global trade passes through unstable regions, insurance becomes a critical factor. Shipping companies normally purchase insurance to protect vessels and cargo against accidents or damage. However, during geopolitical conflicts, an additional type of insurance becomes important. This is known as war risk insurance. War risk insurance covers situations involving military conflict, attacks on ships, or other security threats in high-risk areas. When tensions rise in regions like the Persian Gulf, insurers often increase war risk premiums dramatically. In some cases, certain shipping routes become extremely expensive to insure. For shipping companies, this creates difficult decisions. Some carriers may pass the cost on to customers through war risk surcharges. Others may temporarily suspend services to ports considered too risky. For exporters and importers, this creates another layer of uncertainty. Freight costs increase, insurance premiums rise, and delivery schedules become less predictable. Even when cargo continues moving, the financial cost of logistics operations can increase significantly. As a result, some companies start searching for faster and more reliable transportation options. Air cargo market shock. When ocean shipping becomes unstable or unpredictable, some high-value cargo shifts from sea freight to air freight. Air cargo is significantly faster than ocean shipping. A container vessel traveling from Asia to Europe may take several weeks. A cargo aircraft can deliver the same goods within a few days. However, air freight also comes with much higher costs. This means only certain types of cargo typically move by air. High-value electronics, pharmaceuticals, medical supplies, and urgent industrial components are common examples. During geopolitical disruptions, demand for air freight can rise quickly. Companies facing delayed ocean shipments may choose to move urgent cargo by air to avoid production shutdowns or inventory shortages. But air cargo capacity is limited. Aircraft space is not unlimited, and passenger flights, which normally carry cargo in their lower decks, may also be affected by regional tensions. When demand increases faster than capacity, air freight rates can rise dramatically. The result is a two-speed supply chain. Critical goods move quickly by air at high cost, while less urgent cargo waits longer in congested shipping networks. This situation can also change the timing of global shipping demand. Early peak season in global logistics. One interesting effect of geopolitical uncertainty is something logistics professionals call an early peak season. Normally, global shipping demand follows seasonal patterns. For example, ocean freight demand typically rises before major retail seasons, such as back to school or the year-end holidays. However, when companies expect disruptions in the future, they often accelerate shipments earlier than planned. Importers may decide to move inventory months ahead of schedule in order to avoid potential delays later. Manufacturers may increase safety stock to protect against supply interruptions. When many companies make the same decision at the same time, global freight demand suddenly increases. Shipping lines begin experiencing vessel space shortages earlier in the year. Freight rates start rising sooner than usual. Logistics networks enter peak season pressure even before the traditional shipping season begins. This behavior can amplify the impact of geopolitical disruptions across the entire supply chain. And the ripple effects do not stop with logistics providers. Supply chain ripple effects across industries. When logistics networks slow down or become more expensive, the impact spreads across many industries. Manufacturers may experience delays in receiving raw materials or components. Production lines may need to adjust schedules or slow down operations. Retailers may face longer replenishment times for inventory. Products that normally arrive on predictable schedules may be delayed by weeks. Industries that rely heavily on fuel, such as aviation, chemicals, and heavy manufacturing, may experience higher operating costs. These disruptions can spread across multiple layers of supply chains, creating what experts often call ripple effects. A single disruption in transportation can trigger secondary problems in production, inventory management, and distribution. For global businesses, understanding these ripple effects is becoming increasingly important. Long-term strategic changes in global logistics. If geopolitical tensions remain high for an extended period, companies often begin rethinking their supply chain strategies. One common response is supply chain diversification. Instead of relying heavily on a single region for manufacturing or sourcing, companies begin expanding production into multiple locations. Another strategy is nearshoring. This means moving production closer to key consumer markets in order to reduce transportation risks and shorten delivery times. Some businesses also increase strategic inventory levels. Instead of operating with extremely lean supply chains, they maintain larger safety stocks to absorb potential disruptions. These changes may increase short-term costs, but they often improve long-term resilience. In recent years, global supply chains have already been adjusting to geopolitical tensions, trade disputes, and pandemic-related disruptions. A conflict involving Iran could accelerate many of these structural changes. Why geopolitics is now a logistics risk. For many years, logistics planning focused mostly on operational factors such as port capacity, shipping schedules, and transportation costs. Today, another factor has become equally important. Geopolitics. Conflicts, regional instability, and strategic choke points can now influence global logistics networks almost as strongly as economic factors. A war involving Iran would not remain limited to the Middle East. It could quickly affect oil markets, shipping routes, air cargo capacity, freight rates, and supply chain reliability around the world. For businesses involved in international trade, understanding these connections is becoming essential. Because in modern logistics, even a disruption in one narrow waterway can send shockwaves through the entire global supply chain. If videos like this help make global logistics easier to understand, consider liking the video for more deep dives into international shipping, supply chains, and the hidden forces shaping global trade.